What if I told you that the most powerful financial institution on earth doesn't make its money from stocks, bonds, or real estate? What if its real product, the thing it trades, refines, and sells, is something you can't see on a balance sheet? Fear. Not metaphorical fear. Not abstract anxiety. Quantified, predictable, engineered fear. By the end of this story, you'll understand why BlackRock manages $10 trillion in assets, more than the GDP of every country except the US and China combined, and why that number is irrelevant compared to what they actually control. The psychological triggers that move markets before they move. If you like stories that expose what's hidden in plain sight, subscribe to the channel, hit the bell, and leave a like to help us reach 1,000 subscribers. What you're about to hear isn't conspiracy, it's pattern recognition. It's March 1988, New York City. The air in Midtown Manhattan smells like exhaust and pretzels. Inside a modest office on 3rd Avenue, a 35-year-old man named Larry Fink sits at a desk surrounded by computer monitors, bulky CRT screens displaying green numbers on black backgrounds. He's just been fired from First Boston, one of Wall Street's elite firms, after losing $100 million on a bad mortgage bet. His career is over, his reputation destroyed. But sitting in that small office, staring at those flickering screens, Fink realizes something that will change the course of global finance. The market didn't punish him for being wrong about mortgages. It punished him for not predicting human panic. Because the mortgages themselves were fine. The math was solid. The assets were real. What Fink failed to predict was fear contagion, the irrational cascading panic that turns a 5% problem into a 50% collapse. And in that moment, he has an insight that most investors never reach. If fear is predictable, it's tradable. Within months, Fink launches a new company with 7 partners and $5 million in seed funding. They don't call it a hedge fund. They don't call it an investment bank. They call it BlackRock. And their pitch to clients isn't about beating the market. It's about something else entirely. We don't guess. We measure risk. But what they're really measuring isn't financial risk. It's behavioral probability. How likely are people to panic? When will institutions sell? At what price point does fear override logic? By 1994, BlackRock has developed something unprecedented. Aladdin. The Aladdin Risk Management System. On the surface, it's a software platform that analyzes investment portfolios for risk exposure. But beneath the surface, it's doing something far more sophisticated. It's modeling human behavior under stress. And it's getting very, very good at it. To understand how BlackRock became what it is today, you need to understand what happened in the decades after its founding. Not the official history, not the success story told in business schools. The real story, the one hidden in client contracts, algorithm patents, and behavioral psychology research. September 2008. Lower Manhattan. The financial crisis is in full collapse. Lehman Brothers has just declared bankruptcy. AIG is on the verge of failure. The stock market is in free fall. Trillions of dollars are evaporating. Retirement accounts are being destroyed. Panic is everywhere. And in the middle of this chaos, the U.S. government makes an unusual decision. They call Larry Fink. Not the Federal Reserve Chairman, not the Treasury Secretary's team. Larry Fink, a private fund manager. The government hires BlackRock to analyze the toxic assets destroying the financial system, to value the mortgage-backed securities that no one understands, to essentially audit the wreckage and tell the government what's salvageable. BlackRock charges a fee, but what they gain is far more valuable than money. Access. Access to every major bank's portfolio. Access to government stress tests. Access to the Federal Reserve's emergency lending data. They see everything, every position, every vulnerability, every institution's breaking point. And Aladdin, their risk management system, ingests it all. By 2010, when the crisis finally stabilizes, BlackRock has become something unprecedented. The risk manager for the entire financial system. Not officially, but functionally. Because now, when banks need to assess risk, when governments need to stress test portfolios, when pension funds need to evaluate exposure, they all use the same system. Aladdin. BlackRock's proprietary algorithm now sits at the heart of global finance, analyzing over $21 trillion in assets. Not just BlackRock's own holdings, but the holdings of their clients, their competitors, their regulators. They can see the whole board. But here's what most people miss about Aladdin. It's not just analyzing risk, it's predicting behavior. The system doesn't ask, what are these assets worth? It asks, what will people do when they're afraid? It models, at what loss threshold will retail investors panic sell? When will institutional managers liquidate to preserve their jobs? How will media coverage amplify or dampen fear? What narrative will trigger cascading sell-offs? Aladdin doesn't just measure the probability of loss. It measures the probability of panic. And once you can predict panic, you can position yourself ahead of it. 2015. A conference room in BlackRock's Manhattan headquarters. The room is minimalist. White walls, glass table, no windows. 6 people sit around the table: behavioral economists, data scientists, and former intelligence analysts. They're not discussing stocks or bonds. They're discussing sentiment analytics. One of the analysts presents findings from a new project: real-time monitoring of social media, news sentiment, search engine trends, and consumer confidence indexes, all fed into Aladdin's behavioral models. The goal isn't just to react to fear, it's to anticipate it before it manifests. The presentation includes a case study, predicting the Brexit vote. In June 2016, most polls showed Remain winning. Financial markets were calm. Analysts predicted minimal disruption. But BlackRock's sentiment models, tracking Twitter anxiety, Google search patterns, and regional media tone, detected something else. Fear was building in demographics that traditional polls weren't measuring. 3 weeks before the vote, BlackRock began quietly repositioning portfolios, reducing UK exposure, increasing volatility hedges, moving into safe haven assets. When Brexit passed and markets crashed, BlackRock's clients were protected. But more than that, BlackRock profited from the volatility, because they saw the fear coming. Now here's where the story turns. Because by 2017, BlackRock had accumulated so much behavioral data, so much predictive power, that a question emerged internally. If we can predict fear, can we influence it? Not through manipulation, not through conspiracy, but through something more subtle: narrative shaping. Because fear doesn't exist in a vacuum. It requires a story about why things are dangerous, why uncertainty is intolerable, why action must be taken now. And if you can amplify the right story at the right time, you can move markets before anyone realizes what's happening. Let me show you how this works in practice. 2020, January. COVID-19 is still a regional issue. The WHO hasn't declared a pandemic. Markets are at all-time highs. Most investors are optimistic, but BlackRock's behavioral models are flashing red. Not because of epidemiological data. They're not virologists, but because their sentiment analytics are detecting fear acceleration across specific demographics: healthcare workers, supply chain managers, Chinese manufacturing contacts. The fear isn't widespread yet, but it's present, and it's growing exponentially. On February 19, 2020, BlackRock's Internal Risk Committee issues a memo to portfolio managers: reduce equity exposure, increase cash positions, volatility event probable within 30 days. On February 20th, the S&P 500 hits an all-time high. On February 24th, the market begins its fastest collapse in history, dropping 34% in 23 days. BlackRock's clients are already positioned defensively. But here's the twist. While retail investors panic sell at the bottom, BlackRock is buying. By March 23rd, when fear is at its peak and the media is declaring economic apocalypse, BlackRock begins aggressively purchasing equities, real estate funds, and corporate bonds. They buy when fear is maximum, when no one else wants to hold risk. And within 6 months, as markets recover, those positions have generated billions in gains. How did they know? Because they weren't guessing. They were measuring the fear cycle. And the cycle is predictable. Initial anxiety, detected through sentiment analytics. Media amplification, headlines shift from caution to alarm. Institutional positioning, smart money quietly exits. Retail panic, regular investors sell at the bottom. Narrative reversal, media declares worst is over. Recovery phase, those who bought at the bottom profit. BlackRock doesn't cause the cycle, but they've mastered positioning within it. But by 2021, something changes. Because BlackRock realizes they're not just predicting fear anymore, they're becoming a source of it. When BlackRock issues a risk warning, markets react. When they publish economic outlooks, investors reposition. When Larry Fink writes his annual letter to CEOs, corporate strategy shifts. They've become so large, so influential, that their predictions create the behavior they're predicting. It's a feedback loop. They forecast fear. Markets react to the forecast. The reaction validates the forecast. And the loop tightens. 2023. A leaked internal document. A risk analyst at BlackRock writes a memo that's never meant to be public. Our models now account for our own influence on market sentiment. Prediction accuracy has increased to 87% when factoring in media response to our public communications. Translation. They've modeled their own impact on fear. They know that when they speak, markets listen. And they've incorporated that knowledge into their algorithms. At what point does predicting fear become manufacturing it? At what point does risk management become risk creation? These aren't rhetorical questions. They're operational realities. So let me tell you what this story is really about. It's not about BlackRock being evil. It's not about conspiracy. It's about something more fundamental. What happens when one entity becomes so good at predicting human behavior that they stop reacting to markets and start shaping them? Larry Fink didn't set out to buy fear. He set out to understand it, to quantify the unquantifiable, to model panic, to predict the irrational, and he succeeded beyond anyone's imagination. Today, BlackRock doesn't just manage money. They manage behavioral expectations. They don't just invest in companies. They invest in the psychological conditions that determine value. Fear isn't a bug in the system. It's a feature. And BlackRock built the most sophisticated system in history for trading that feature. Here's the uncomfortable truth. Fear will always exist. Markets will always panic. People will always make irrational decisions under stress. That's human nature. What's new is the industrialization of that process. The conversion of anxiety into data, panic into probability, chaos into commodity. BlackRock didn't invent fear, but they perfected the business model around it. And the question we have to ask ourselves is this wrong? Because on one level, BlackRock is just doing what every investor tries to do: predict the future and position accordingly. They're just better at it. But on another level, when one institution controls $10 trillion, manages risk for half the financial system, and can predict and potentially influence global sentiment, at what point does better at predicting become too powerful to exist? I don't have the answer to that question. But I know this. The next time you see a headline about market volatility, economic uncertainty, or global risk, ask yourself, who benefits from my fear? Because somewhere, in a server farm running algorithms you'll never see, Your anxiety is being measured, modeled, and monetized. Not by criminals, not by conspirators, by the most sophisticated risk management system ever created. And it's not predicting the future, it's predicting you. If this story changed how you see the markets, subscribe to the channel and leave a like. It helps more than you can imagine. And remember, fear is real, but it's also profitable. And the billionaire who learned to buy it didn't just get rich. He became the system.